Natural gas futures extended their decline last week, with the June contract settling at $3.33, marking a 12% drop as cooler U.S. temperatures reduced electricity-driven demand. Forecasts indicate mild spring conditions across key regions, accelerating storage injections and keeping market participants cautious. Although some regions experienced brief heat waves, the overall supply-demand balance remains loose, reinforcing a bearish near-term outlook. Meteorologists expect below-normal temperatures to persist across the East and Midwest through late May, which continues to suppress power sector cooling demand. Even as Texas and parts of the South reached highs in the 90s and 100s, much of the lower 48 faced limited air conditioning requirements. While ERCOT has shown signs of regional strength, it has not been enough to influence broader market direction. Weather analysts also noted that without consistent heat, cooling degree days will remain close to or slightly above normal levels, still too weak to materially boost gas use. Natural gas futures have now fallen for 5 consecutive sessions, reflecting growing concern over weak demand and rising stockpiles. The Edison Electric Institute reported a 3% year-over-year decline in U.S. power output for the week ending May 10, underscoring the slowdown in utility-driven gas consumption. Although gas-fired generation saw a modest uptick as renewable output fell, it was not enough to alter the prevailing fundamentals. With production holding steady and weather forecasts offering little support, the burden remains on demand to restore market balance. With mild spring weather keeping demand in check, robust production levels, and storage injections running above the seasonal norm, the short-term outlook for natural gas remains firmly bearish. Traders should keep a close eye on upcoming weather models and the next EIA storage report for any early signs of tightening fundamentals. Until then, market control remains with the sellers. Natural gas futures ended the week below a key pivot level at $3.50, which has now turned into resistance. This breakdown suggests increasing bearish momentum and raises the likelihood of a move toward the 50-week moving average at $3.06, a level that previously helped steady prices in late April and early May. Should this support fail, attention will shift to the April low at $3. A decisive break below the threshold could open the door to a deeper correction, with $2.85 standing out as the next significant downside target. Please like, subscribe, and comment to support the channel. See you in the next one.